Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 top analyst industrial stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. For today's stocks, I narrowed in on a top analyst in the industrial sector. We found 3 stocks that he's recently rated a buy, plus other Wall Street analysts agree. In fact, all 3 of today's stocks come in with unanimous strong buy ratings. So we're going to take a look at these companies, what it is that they do, and of course what those Wall Street analysts are predicting for the stock's future. We found this top analyst under the TipRanks Top Experts page. Under the Experts menu, we headed over to Top Analyst and looked at the industrial sector to find Josh Sullivan from Benchmark. He's currently a 5-star analyst ranked 25 out of over 9,300 Wall Street analysts. Just before we dive into these 3 stock picks, this is a reminder that to celebrate Valentine's Day, TipRanks is having a great sale. Right now, you can get 30% off TipRanks premium subscriptions and our Smart Investor newsletters, so head on over to the TipRanks website to take advantage or follow the links in the comments down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's dive right into these strong buy industrial stocks. First on the list, we're taking a look at AAR. They trade under the ticker AIR, or AIR, currently priced just above $68 per share, and you can see they have seen some volatility this past year. Overall, they are up 8.5%, though slightly in the red over the last few months, down 0.3%. AAR provides products and services to the commercial aviation and government and defense industries. They are one of the largest independent providers of new and used aircraft parts globally, selling and distributing parts for engines, airframes, and other components for both the commercial airline and government customers. They act as a distributor for over 25 OEMs and support customers in over 100 countries. On top of that, they also provide maintenance, repair, and overhaul services. They shared their second quarter earnings report back on January 7th, coming out with both an earnings and revenue beat, plus record-breaking sales growth. For their Q2, they reported earnings per share of 90 cents, beating expectations by 5 cents per share. Revenue came in at $686 million, beating estimates by $32 million and climbing 26% year over year. And management said that they anticipate continued strong sales growth in the second half of the fiscal year. Now we know our 5-star benchmark analyst rates the stock a buy, but also recently initiating coverage was an analyst from KeyBank. They cited a favorable macro backdrop for the company given its exposure to the multi-year upcycle in aerospace and defense, particularly within aftermarket. They are a net beneficiary of ongoing OEM challenges as older planes re-enter the global fleet and drive strong demand for aftermarket parts, and that they see further efficiency improvements within their repair and engineering segment at their hangars, which are currently at or near full capacity. While AAR does just have 4 current analyst ratings, they all come in with a buy. And the average price target is $80.50, implying an upside potential of about 18% from here. Looking at those ratings down below, on the low end we have $75 from RBC for an upside just shy of 10%, and we have 2 at our high end of $83, including Josh from Benchmark, for an upside of over 21%. For our second top analyst industrial stock, we have Carpenter Technology. They trade under the ticker CRS, currently priced at $186 per share after seeing some huge growth this past year, gaining over 200%. In the last 3 months, though, they're just up 5%, having cooled off a bit following their earnings. Carpenter Technologies is a global leader in the development, manufacturing, and distribution of specialty alloys, including stainless steels, titanium alloys, and other high-performance materials. The company serves industries requiring advanced materials for critical applications such as aerospace, defense, medical, energy, transportation, and industrial markets. They produce high-temperature super alloys like nickel, iron, and cobalt base, and high-strength steels, implantable alloys, magnetic and controlled expansion alloys, and tool and die steels. Now, I know I said that the stock did sell off following their latest earnings report, but overall it wasn't that bad. While they did miss on revenue, the company had an earnings beat, provided some upbeat outlook, and had their second most profitable quarter ever on record. For their Q2, they reported earnings per share of $1.66, beating expectations by 5 cents per share, while revenue came in at $676 million, which did miss by nearly $47 million, but did grow by over 8%. And they did generate $119 million in operating income, which was a 70% increase over the second quarter of last year, marking their second most profitable quarter. They increased their fiscal year guidance for operating income between $500 to $520 million. One analyst weighing in on the stock following that earnings report came from JP Morgan, who said that the sell-off is overdone. Post-sell-off, they see an attractive entry point, believing that Carpenter's long-term outlook remains sturdy even if air pockets persist for another 1 to 2 quarters. They feel that the company's protective moat and robust backlog should drive further upside next year. And just last week, our 5-star analyst from Benchmark increased their price target by $75. Commenting that Carpenter's hypergrowth and margin recovery from the depths of COVID has been massively impressive, but the company is now entering the next phase of the story, which the firm believes is a cash generation and yield-focused story with continued growth and margin expansion. The recent pullback following Q3 due to the Boeing-related customers adjusting for the production re-ramp is misguided. And altogether, there are 5 analysts with current ratings on the Carpenter Technology stock, all rating it a buy, with an average price target of $244, implying an upside potential of 31% from current prices. Looking at those ratings down below, our low end is $220 from TD Cowen for an upside of about 18%, while our high-end price target is $288 from Deutsche Bank for an upside of over 54%. You guys know the deal. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Third is a stock we actually talked about back in October of 2023. That is FTAI Aviation. The stock trades under the ticker FTAI, currently priced at $115, and over the past year, it has climbed 122%. In the last 3 months, however, it has dropped 28%. FTAI specializes in aviation leasing, maintenance, and aftermarket services. They primarily focus on aircraft engines, particularly the CFM56 engines, which are widely used in commercial aircraft. Their key business segments include engine leasing and sales, aftermarket services providing maintenance, repairs, and parts, and their modular factory program, which is an innovative approach allowing airlines to replace engine modules instead of performing full overhauls. Now, as you saw, the stock has been selling off recently, and the catalyst behind that was a short report from Muddy Waters in mid-January, which was then quickly followed by a second short report from Snowcap Research just 2 weeks later. In the initial short report from Muddy Waters, they said that their financial reporting is highly misleading and that they believe revenue from true maintenance and individual off-the-rack module sales are materially lower than reported. But many Wall Street analysts came to the company's defense, one from Citi saying that Muddy Waters' arguments were hard to understand. The Citi analyst noted the knee-jerk share price response to the short report, but said that some of the key arguments seem a little hard to understand. Another analyst from Wolfe Research said that the sell-off brings a very attractive entry point. They said that the Muddy Waters short report on FTAI does not appear to consider the impact of the company's recently announced strategic capital initiative, which is a key driver to future positive earnings revisions and also goes to addressing 2 of Wolfe's prior concerns, capital intensity and penetration. Second, the majority of the report should come of no surprise to investors, as Wolfe has frequently written about FTAI's unique accounting and overall business complexity. And then 2 weeks later came the other short report from Snowcap Research. The report was released at the end of January, and the firm says that their investigation uncovered evidence of aggressive inventory accounting, repackaged COVID trading gains, and more misleading claims about its aerospace business. Following this short report, we did hear from our 5-star analyst at Benchmark. He comments that the company has been subject to accusations of improper accounting and undervaluing its engine module swaps. However, these claims are deemed unfounded. They said that their CEO has effectively addressed these concerns by explaining the company's depreciation methods, which are backed by third-party testing, and the significant impact of the engine swaps on the aerospace industry. So, 2 short reports in 1 month, definitely a bit of a red flag, but basically all of the Wall Street analysts that cover the stock seem to strongly disagree. Now, in about a week, we'll have their next earnings report coming up on the 20th. And for that fourth quarter report, analysts are anticipating earnings per share of 89 cents, which would be a slight decrease from last year's. This does follow their third quarter where they had mixed results, with their earnings per share falling 2 cents short of analyst expectations, while revenue of $465 million did beat by $45 million. FTAI has 11 current analyst ratings, coming in as a unanimous strong buy. and their average price target comes in at $186, implying an impressive upside potential of 62%. Looking at those ratings down below, pretty much all of them coming post those short reports in the last few weeks. Our low-end price target is $100 from Stifel Nicholas, which is a downside of 12.5%, while our high-end price target is $300 from our 5-star analyst at Benchmark, which would be a whopping upside of 162%. So that is a quick look at 3 stocks in the industrial sector, all with buy ratings from a top-ranked analyst and an overall strong buy consensus from Wall Street as well. Let me know your thoughts on these 3 companies in the comments down below and which one catches your eye the most. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are looking at, so please make sure you always stick to your own investment plan. Thank you guys so much for watching, have a wonderful day, and I'll see you back here next time.